I noticed my breakfast cost me $1 more this morning. I asked the cashier, even though I knew the answer for the why there was a price increase, and that the diner had added a 50-cent per egg surcharge to account for the inflation in egg prices due to the bird flu epidemic. In this video, I'm going to discuss some of the considerations involved in choosing whether to own an equity REIT, real estate investment trust, common stock, and or its preferred stock. In many cases, I own both the common and the preferred stock. The first item to discuss is whether the preferred dividends paid by REITs are entitled to the Section 199A classification that allows a 20% deduction in the amount that is subject to tax. This special favorable tax treatment expires at year end unless the Republicans renew it along with other tax laws that expire. The Section 199A information can be found on IRS Form 8995. That's where my TurboTax puts it after collecting it from my various brokerage downloads. While I had the answer to that question buried deep in my malfunctioning memory retrieval system, I was unable to locate the file this morning, so I refreshed my recollection with research that include looking at my 2023 1099 forms, press releases from REITs that classify their dividends into the various relevant categories, and there are many categories there. The answer is that the part of the preferred REIT dividend classified as ordinary income that would be taxed at ordinary income rates will receive the 199A deduction. That would exclude any part classified as a capital gain or as a return of capital. I try to understand the bare minimum of federal tax laws. I always have found those extremely boring. I can barely tolerate spending time to learn what I need to know about them, and only to the extent that they impact my investment decisions. Since the ordinary income sourcing of both REIT, common, and preferred stock dividends are treated as Section 199A dividends, there is no reason to consider that tax issue when making an investment decision to buy one or the other or both. It would be an issue if the preferred stock dividend was not entitled to the same deduction as the common share dividend. There are, however, other important key considerations. Equity REIT preferred stocks pay cumulative dividends. That simply means that a dividend cannot be eliminated short of a bankruptcy, but only deferred. The deferral requires a condition predicate to occur before the REIT can defer preferred cumulative dividend, which is the elimination of a common share cash dividend and no cash used to buy back common stock. This preferential right to cash is enforced in the what's called the stopper clause in a preferred stock prospectus. And as a practical matter, if the REIT has net income, it has to pay a common share dividend, cash dividend, or it will lose its tax status. The common share dividend, however, can be cut, which is not the case for a cumulative preferred dividend. The preferred dividend has to be paid in full if it's not lawfully deferred. If the preferred dividend is lawfully deferred, it has to be paid in full when and if the REIT assumes a common share cash dividend after eliminating it. This has happened in the past with several hotel REITs during the pandemic, where they eliminated their common cash dividend. and deferred their cumulative preferred dividends. And when they resumed their common cash dividends, they paid all the outstanding deferred preferred dividends. Now, they don't pay any interest on those deferrals. They just pay the amount that had been deferred. The preferred share has no equity in the business, and that's a downer. If the REIT is acquired at some premium price, the preferred shareholder who has no equity ownership in the business will receive nothing other than an assumption of the obligation to pay dividends, hopefully by a more credit-worthy entity. I have seen one or two examples in the past, a long time ago, where there was a leveraged private buyout and the REIT went bankrupt as a result of the increased leverage, and the preferred shareholder ended up with nothing, even though the common shareholders received a nice premium to their share price as part of the acquisition. To give an example, a real world example from my own portfolio, I own both the common and preferred shares of a company called Gladstone Commercial REIT. The common shares are traded under the symbol GOOD, and the preferred stock symbol that I own is GOODN. Both pay monthly dividends. GOODN has a 6.625% coupon that is paid on a $25 par value. And the price on last Friday, February 14th, closed at $23.04. The yield at that price is 7.19%. The common dividend, which is paid monthly, is currently at 10 cents per share. The share price closed on February 14th at $16.21. The dividend yield at that price is 7.4%. In many cases, the REIT common shares have a lower yield than its preferred stock or stocks, reflecting, in my opinion, mostly the ownership interest in the business, which has value that the preferred shareholder does not have. For good, the preferred yield is less than the common shares, and the reason for that, in my opinion, is that the common share dividend was cut from 0.1254 per share paid monthly, effective for the January 2023 payment. From the preferred shareholders' perspective, cutting the cash common dividend is welcomed. The more the better. Just pay some cash to those people that own the common stock, the preferred shareholder would say, in order to protect me from having my dividend deferred. And having more cash going out, having less cash going out to the common shareholder is always a benefit to the preferred shareholder. I discuss the good common and preferred stocks in my blog. Go to the profile page and there's a link. You just click South Gen, I think, and it takes you to the profile page, and then there's a link to the blog. A symbol list is on the right-hand side. Click the symbol, and you will be taken to the last discussion of a security with that symbol, and just clicking add it. And just at the bottom of the page, if you click more pages, then it'll take you to the next discussion of that symbol. While I own 200 to 250, sometimes more dividend-paying common stocks, my current allocation to stocks is less than 10% of the total amount held in my brokerage accounts. My position in good, GOOD, is only 40 shares with an average cost per share of $8.78. I've sold my higher cost shares profitably over the years. My last discussion, which was a pair of the existing position that brought me down to 40 shares, was in a November 7, 2024 post at item 3O, which has a snapshot of my existing position. I own 70 shares of GOODN, the equity preferred shares, and it's spread out over 3 accounts. There's no good rational explanation why I own that symbol, that preferred share, in 3 of my taxable accounts and probably an IRA account as well. My weighted average yield is over 9% for that preferred stock. I have not sold any shares recently to my memory.